Hi there, everybody. I'm Roland over at Keller Williams. I am a realtor, and I have a very special guest with me here today. We're going to be talking about loans, especially for first-time buyers, really actually all buyers, what the process is, what it's going to kind of look like, because we want you to be really comfortable when it comes to knowing what to do with buying a home. And so I have Jessica Valenzuela. She is totally awesome. She just finished up a loan for my son, who's actually 29, and he bought his first house. And I mean, if it could go as smooth as this all the time, it was just awesome. So it was really great. You did a great job. So Jessica, introduce yourself a little bit. Tell us about who you
Hi,
are.
yes, thank you so much, and I appreciate you very much. My name is Jessica Valenzuela. I am a senior loan officer at Keller Mortgage. I've been in the industry together for about 20 years. So I come from a background in title. I worked for a title company for 8 years, and I've been in mortgage for going on 12 years now. So I do have the extensive background. I love what I do. I love helping people achieve their home ownership dreams. I know that is very important for a lot of, a lot of people, whether you're young or older, whether it's your first home, your forever home. It's an important process that could seem daunting, but with people like yourself, having the right people on your side is what's going to make the transaction go smoother.
Absolutely. And I always believe in having a really great team surround me. And that's everything from title, mortgage, all your appraisers and lenders and all that other, inspectors and that kind of thing. And so, yeah, it's really important to have the right people in the right place. And so what should a person ultimately, as they're kind of considering, they're renting right now, or most of them are renting right now, or if they have a house that they are needing to sell or something like that, moving into the buying process or thinking about buying, what are some things that you would suggest that they start planning for?
The first thing they want to do is connect with a real estate agent like yourself. They should definitely reach out to you, let you know what their goals are in the time frame. Once they've met with you, they definitely need to contact their lender, which they can reach out to me with any questions. I will look at their income, assets, credit, their whole profile, and be able to guide them not only into, do they need to sell their home? Maybe they can keep it as a rental. Maybe they qualify with both. We can look at various options.
Sure.
I could also let them know maybe they're thinking initially of an FHA loan. A lot of consumers think that that's the easier loan, but I can look at their portfolio and determine if conventional might be a little better for them. For first-time home buyers, there are options for conventional with as low as 3% down. So that's a little less than FHA minimum requirement of 3.5. So it's important to speak to a lender, a loan officer, so you know all your options and you're not just thinking that you don't qualify because you might not have 20% down. Sure. Or a larger down payment. There are various options out there.
Okay. So I know that we're in kind of a weird time right now in terms of the COVID and everything like that. But what is your take on the mortgage market right now?
The mortgage market has changed, and that's a given. We've heard it in the news, we've read about it in different articles. However, it's still very strong. The market rates are very low for qualified buyers. Some of the major changes that have happened are going to be for someone maybe with a lower credit score. So a lot of investors, and it's not FHA or Fannie or Freddie making the changes. It's mainly investors that have added additional overlays and changed their guidelines for someone that has a credit score, let's say below a 640. Anything below a 640 is going to be a little bit harder to qualify for, and that's because it's considered a riskier loan. And with, like you said, the coronavirus and the current economy and the crisis that's happening, just a lot of consumers might be defaulting, so that's putting investors a little bit on the fence. However, with the right credit score and the right team behind you, you can close on time or early. There's a lot of options. And like I mentioned, the market is strong. The rates are fantastic.
Oh yeah.
I mean, really, really, really great. So I know a lot of people might be hesitant because of what they read and hear, but it's important to understand that you don't need 20% still, and that the market is great. It is a great time to buy and lock in on these low interest rates.
Yeah. I remember my very first home back in the early 80s I bought, uh, rates were 16%. I
Yeah.
mean, that was what it was,
And,
And,
and you're used to
and
it, right?
oh yeah, and I didn't know any better. I thought, wow, that's great. We get to buy a home for
Yeah,
16%. How awesome is that? you know.
yeah, yeah.
And then my
And
second home was 6% back in the early 2000s,
yeah,
and so now, I mean, like they're kind of hovering where right now?
that's what I was going to mention. Back in the 2000s, when I first got into the industry, the rates were at 5, 6, and
Hmm.
that was normal. Right now, we're seeing historically low rates, low threes, a few twos. So it's high twos, of course. I know. I get excited when I see that,
Fathom that.
but definitely it all depends on the buyer's profile, where credit is one of the very important aspects of somebody qualifying. So it's important to maintain your payments on time, keep your credit utilization low. That means your credit card usage to a minimum. So you want to use your credit cards so you can report and actually generate scores, but keep it to a minimal. Don't max out. Don't do that, and you'll see how quickly your credit goes up. And of course, you get way better options when it comes to interest rates and just programs in general with a higher score.
So, talking about credit utilization, I
Hmm.
know, what would you say you would recommend if you can, a really kind of an ideal
A balance,
payment?
yeah. Definitely. I am not a credit repair agent, so please don't quote me on this. Always do your due diligence and double check. But keeping your utilization below 30% is what I've read that is recommended by most experts. So, just keep your available limit at 70% or higher,
Mm.
compared to your balance. I have, on the other side, there's consumers that don't like credit. They don't want to spend anything at all, and they don't use their credit cards, and eventually the bank or the credit card company will close their accounts. That has a negative impact as well. So I suggest for these type of buyers to once in a while go buy a Starbucks or pay for lunch. Let that credit card use, even if it's $5, $10, that'll keep your account open, and it will really help with your credit score.
Absolutely. And so, we were talking about interest rates just a minute ago, and I'll probably throw a little curveball in there, but I'm really good at that. So just
Yeah,
beware.
yeah.
So let's say the person has an interest rate of a mid threes, okay, 3.5, whatever,
Mhm.
and then compared to an interest rate of 6% on, let's say, a $200,000 loan, what kind of difference in the payment would that make
For a
typically?
$200,000
Uh-huh.
purchase price, it's going to depend on the type of financing, whether we're looking at FHA or conventional. But we can do the scenario based on a conventional, as conventional loan. The interest rate affects principal and interest only. So it going from a 4 to a 3 has a significant change in view. So for 200,000 purchase price at a 4% interest rate, with a minimum of 5% down payment, your principal and interest is 633.33.
Okay.
When we drop that rate to, let's say, 3.5, even just half a point, your monthly payment goes down to 554.17.
Wow,
So
that's almost a
it,
hundred bucks.
it's significant. Yes,
Right.
yes. That's why it is important to really, try to have your credit as best as possible. And until you apply and a lender actually pulls your credit, you're not going to know. And if anything needs to be worked on as far as the credit, it's better to know ahead of time, not when
Yeah.
you've found the home, right?
Wow, such a significant difference, and
It really is.
especially in this kind of market, because a lower interest rate, it could potentially, and correct me if I'm wrong, allow you to buy a little bit more. Would that be
Oh, yeah,
correct?
definitely. Yes, yes, yes. You have more purchasing power as far as the purchase price goes
Hmm.
if your rate is lower because your monthly payment will be lower as opposed to somebody having a higher rate.
Yep.
It really does give you more of a purchasing power when you have a lower interest rate option.
Yeah. So, Jessica, you are with Keller Mortgage,
Mhm.
and that is a fantastic program.
It is.
And,
Yes.
so tell me a little bit about, or tell us a little bit about that program and what the benefits are for the consumer.
Yes, well, Keller Mortgage is affiliated to Keller Williams. When a buyer is working with a Keller Williams agent or purchasing a home that's listed by a Keller Williams agent and they apply with Keller Mortgage, we offer something called Zero Plus. What that is, it's incentives for closing costs. Keller Mortgage waives lender fees. We have no lender fees at all, no origination, no processing, no underwriting. Plus, on loan amounts that are over 150,000, we'll also give the buyer $1,000 credit towards third-party closing costs. Again, the caveat is that there needs to be a Keller Williams realtor as yourself representing the buyer or representing the seller on the listing. So it is advantageous to both listings and buyers because you have the same savings. Another great thing that Keller Mortgage offers is appraisal reports being
Yeah.
ordered immediately. A lot of lenders will wait until after option period to order an appraisal, which is understandable, but we lose about a week, maybe, right, during that option period. With Keller
Mhm.
Mortgage, that appraisal is ordered immediately. If anything were to happen and the buyer not move forward with the purchase, that appraisal fee is not passed on to the buyer. The appraisal fee is paid for at closing if the loan closes. So, but the real savings is in the Zero Plus, zero lender fees plus $1,000 credit if the loan amount is over 150,000. If the loan amount is under 150,000, the $150,000, you still get the zero lender fees.
Right.
Yeah.
And so, just kind of speaking of fees, what would be a typical, when a buyer comes to the table, they have, let's say on an FHA, they have
Mhm.
3.5% of whatever the purchase price will be that they need to
Yes.
bring to the table. And typically, what would the other fees kind of be?
The third party fees will consist of title company fees, which include recording, document preparation, possibly courier fee, tax certificates, title policy. You have both owners and lenders title policy. You also have appraisal fees, possibly a survey if one is needed. And then you have what is called your prepaids and reserves. Prepaid is anything that's literally prepaid, such as your homeowner's insurance. A whole full year of homeowner's insurance is collected up front. You also have daily interest. Depending on your closing date, interest is collected. Then your reserves. The reserves is the money held in your escrow account to pay for taxes and insurance when they become due. Taxes are due each year at the end of the year, and insurance will be due each anniversary from your date of closing. So that money is held in your escrow account by your loan servicer or your lender, and it's paid automatically either to the county for your property taxes or to your homeowner's insurance agent for your insurance.
Okay. So the buyer really doesn't have to worry about any additional payments that they're going to have to make during the
Correct.
year.
Yes, the mortgage payment will include your escrow account to pay for taxes and insurance. Depending on the loan program, for a conventional buyer that's putting 20% down, they might wish to waive this and handle payment for the taxes and insurance themselves. But in general, most people do include the escrow in your monthly mortgage payment.
Yeah, and that's perfect. So let's talk a little bit about buyers. What do they need to kind of be prepared for? What are some do's and don'ts right now for them?
So the you need to be prepared with providing certain documentation after you've completed the initial application.
All right.
These will be what I call like the verifications, and you need to have 2 years of income filed tax returns. That would be the most recent 2 years. You also have to have 2 years W-2s or 1099, depending on how you're paid. You need at least 30-day pay stubs. That's if you are just a base salary earner. Sometimes there's additional pay stubs required if you're earning something like commission or bonus income or overtime. Then you need your 2-month bank statement. A bank statement could be checking savings, 401k, investment, retirement account. The bank statements that will show where the funds needed are coming from.
Okay.
And lastly, you need your driver's license or government issued ID and the social security card. So those are the very standard documents that you'll need pretty much in any application with any lender. Depending on the situation, there might be other items required. We'll get to the do's and don'ts next, but one of my big do's is always communicate with your loan officer. We're here to help you get the mortgage, and we want to help. So we'll let you know what's needed always.
So a couple of questions related to the documentation, okay? And so what we know is they need to have 2 years filed tax returns. Do they need the whole tax return or just the W-2?
I typically ask for the whole tax return. Depending on what type of income you're earning. If you're self-employed or Schedule C income being reported, then we definitely need all the schedules. You might have rental properties as well being listed there, which we want to use as as a positive in your application as well. So each case is different. If you file just an easy 1040, then it would just be the one document that we need. So
Okay.
Definitely, if you're not sure, always reach out to your loan officer and we'll let you know.
So what about if they, how long should they be on their job, their W-2 job?
So we always verify a 2-year employment history, at least 2 years. But let's say for our recent college graduates that might not have a 2-year employment history, that is okay. We can still help with a mortgage loan without someone having the 2-year employment history. We just need to know what you are doing. If it's a college graduate, then obviously we would have the transcripts from when they were in school or the diploma. Let's say that there's a gap of employment either due to maybe a new baby being born or someone took time off to take care of a sick family member or sick themselves, then we can explain a job gap. And again, every scenario is different and every loan program requires different documentation. So it's important just to speak to your loan officer to be sure that you are okay with your specific scenario.
Okay. And then on the 30-day pay stub, the bank is really looking at, or the lender's really looking at kind of a year-to-date and consistency. Is that correct?
Yeah, that is, yes, that is what we're looking at. With our world nowadays and technology being what it is, a lot of home buyers maybe are not prepared with the actual physical pay stub, right? Because we don't get paper pay stubs anymore from our employers. But it is important that you obtain these when you're applying for a mortgage because we use the year-to-date income for qualifying purposes. We need to make sure if there's deductions that you're paying back for anything that will be taken into account. And we want to make sure that if you are working 40 hours or if you should be working 40 hours and we're trying to use that income in qualifying, that your pay stubs reflect the average income that you should be earning.
Okay, perfect. And then bank statements. So their down payment, let's talk about that a little bit because I know that there are specific rules related to down payment. And so what should they not or do or whatever?
Yes, so bank statements could cause significant issues with your loan depending on what's shown there. We obviously know we don't want to see overdrafts and NSFs and that sort of things, but deposits, it's something that we're going to look at too. Any large deposits that are on your bank statement that are not payroll will have to be sourced, meaning we need to know where that money came from. Maybe we can do another episode called mattress money because that's a big thing. What is considered mattress money, or that's a term that's used, is basically cash money that someone might have saved at home, but they've been saving it for a while, or maybe it was something that they were given, and there's really no paper trail. We don't know where the money came from. That funds, that cash deposit, can't be used if it's a certain amount above what your pay is. So if you're depositing $10,000 that you can't source, that will be an issue when the lender, starts reviewing your bank statement. So it's important to have a paper trail always on your deposits. And again, if your regular pay is whatever the amount it is, and we can clearly see that that's payroll, you're fine. We'll be okay with that. If you're transferring money from one account to another, again, we can paper trail it, so we can see that. That's fine. It's just unsourceable large deposits that become the issue.
Okay, that's fair enough. And one thing I learned on the driver's license, make sure that it's not expired.
Yes, true. Yes, because good luck trying to get one right now, right? If you have
Yep.
to actually go in.
Oh yeah. All right, I'm
The,
going to go to the do's and the don'ts, and we'll
yeah.
just go through these real quick here. All right, let's do the don'ts.
So the don'ts, it's going to be very basic information. Don't change jobs without speaking to your lender. Don't go from being a W-2 employee to being self-employed. We need a 2-year tax return history of income filed as self-employed in order to use this for qualifying. Don't go get a new car, even if you get a pre-approval. Don't do that. Don't overuse your credit cards. Don't miss a payment on your credit cards. Don't spend the money you need for closing, the money in your savings. Don't go get new furniture yet. Wait until you've closed. Don't get a new credit inquiry. So if you're in process and you're at the store and the cashier tells you if you apply with them, you'll get an extra discount, hold off. That 10-15% savings is really not worth the additional documents that we'll need. Possibly adding a new debt could cause issues with your qualifying. We just don't want that. Don't make any large deposits, and don't co-sign for anybody. Even if it's your family, sister, brother, child, it could cause, again, your loan to no longer qualify, and just, you don't want to do that.
That's for sure. All right, let's do the do's, because these are the fun things.
Yes. Do continue to make your rent or housing payment on time, as well as do continue to make any credit card or installment debt that you have, their payments on time. Do keep your same employer. Don't change employers, remember. And as always, do call your loan officer if you have any questions and you're not sure if doing something might jeopardize your transaction. That's what we're here for. We're here to help, and we'll let you know if it'll impact you.
Perfect, man. That's pretty awesome.
Yeah.
So, Jessica, we're about the end of our little deal here. And so any kind of last words of wisdom or thoughts for our people out there?
Yes. Again, I think that some people might think that it's just daunting or a scary process and don't know where to begin. The first step is asking questions, connecting with a real estate agent that will then help guide you to a lender, allowing the lender to view your full profile, where it's credit, income, assets, and then from there being able to see what you really qualify for, and moving forward. It is a great time to buy. We've said it plenty of times. Right now, the rates are amazing, so you don't want to miss out of the current wonderful interest rates.
Yeah, and I would totally agree with you. Reach out to your realtor, and in this case, reach out to me, because
Yes.
we can take you through the process.
Yes, definitely.
And then definitely we're going to hook you up with Jessica. She does a fantastic job. And the thing about it is that there really are no questions that are dumb or should not be asked. You just need to ask them, because
Yes.
everybody has the same questions, and it's okay. And I will tell you this, going through Keller Mortgage in this case, they have a portal where when you are in it, it tells you everything that's going on with the whole process. One of the things that we want all the time is communication,
Yes.
because we don't want to be sweating it out in the middle of the night, wondering, I wonder what's going on and all this. You're going to know right away. And when you reach out by text or email or voice call,
Always.
you're going to get all those answers. And
Mhm.
so we really want to invite you to go on this trip with us and take this journey to home ownership because we really can help you to do that. And if you're not certain right now, the best thing is let's go ahead and get you submit an application, because the worst that could happen is that something's going to come back and says, hey, you need to do this
Need to
before
do
you can
something.
do
Yeah.
this. And that's okay. There's no shame in that or anything. It's just a great way to start. And
Hmm.
if you're able to do something, then we absolutely would get through the process and help you to make that all happen. Because there's nothing better than owning a home, and
Yes.
it's
Knowledge is power, right?
oh, it really is,
It really is. Yeah. Yeah.
I know that I was talking to my son. He just bought his house, and one of the things is, you got neighbors above you, you got neighbors beside you, those
Yeah. Nice.
it
Yeah.
stinks, and he was going to actually rent a house, uh, and ended up being that his mortgage payment would only be $200 more
Yeah.
than what he would have actually been had to have rented out in where he wanted to rent.
Exactly.
It just makes sense.
And he would own the property, so
Mm.
definitely it's a smart move. And like you said, if you don't start, you won't know.
That's
Some
right.
people think that they're not ready, and they really are. Vice versa, some people think that they're ready, and they might need something, a little work on credit, or maybe a little bit more income, or just something. But that's what we're here for, to help you achieve your homeownership dream. And we know this is a very important and special process for most home buyers. So whether it's your first home, your forever home, even if you're downsizing, we understand that it's important, and we want to make it as easy as possible for you.
That's right. And we want to thank all of you guys for tuning in. And if you do have any questions, just contact us. We'll have a couple of buttons there for you to click on, and we'll get back in contact with you and get you started on your journey home.
Yeah,
All
please
right.
do.
Thank you, Jessica, and
Thank
have a great
you.
day.
Thank you.
All right.